Hello, everybody. Adam Bergman here. I got Steve Blackwell today. We're going to be talking about how you can eliminate all your taxes on a Roth conversion by using an oil and gas investment strategy. So we'll start the presentation. Before I start, I just want to say that this is for educational purposes. So I'm not obviously advising anyone, providing anyone investment advice as to whether to do an oil and gas investment or the advantages of it. This is strictly a webinar to educate people on, first of all, how Roth conversions work and the ability to potentially shelter the tax due on a Roth conversion by using an oil and gas investment. So whether you use an oil and gas investment that's provided by Steve or someone else, this webinar is really about education. So Steve, do you want to give a quick 1-2 minute intro about who you are?
Yeah, happy to be here. Thanks for setting this up again. We did this last year, so it was fun last year. Looking forward to having this conversation again. My name is Steve Blackwell. I'm the CEO of Invito Energy Partners. So we run a fund that invests into the oil and gas space, specifically drilling of new wells, acquiring working interest in new wells, which is the specific asset class that offers the big tax write-off on the front side, which is what you can leverage inside of a Roth conversion. So I've been an executive running upstream oil and gas companies for about the last 17 years. My partner and co-founder, Jared Christensen, and I, this is our third company together. And we started Invito Energy Partners a few years ago. And love talking about oil and gas and love talking about tax.
Yeah, with your accounting degree, I get it.
So.
That's why we get along. So you guys know about me, tax attorney, founded IRA Financial, put up with 25,000 accounts, $4 billion in assets. And this is what I love doing, educating people about the power of the U.S. retirement system. So this webinar, I'm going to focus my section on the Roth IRA and the conversion. And then Steve will jump into oil and gas in about 5 or 10 minutes. So just quickly, what's a Roth IRA, right? A Roth IRA was created in 1997 by Senator Roth. It's an after-tax account. The most you can put in a Roth IRA, $7,000 or $8,000 if you're over 50. It's the same numbers in 24 as in 25. Contributions are due by April 15th, no extensions. Now, technically, if you make more than $161,000 if you're single or $240, married, filed jointly in 24, you technically cannot do a Roth IRA. But if you've been watching my videos, listen to my podcast, reading my blogs, you know that's not true, because you can do what's called a backdoor Roth IRA, which since 2010, there are no conversion limitations for Roth conversions. So now anyone, either Jeff Bezos, Warren Buffett, or you and me, we can do Roth conversions irrespective of our income. We can also make Roth contributions by doing an after-tax IRA and then simply converting the after-tax funds to Roth. And since you're going after-tax to Roth, there's no tax on the conversion or the movement of the funds from the Roth, the after-tax to the Roth. So a Roth is an after-tax account. So why would you want a Roth instead of an after-tax? Well, a Roth IRA, so long as you're 59 and a half and the Roth's been open at least 5 years, all Roth distributions are tax-free. Okay, whereas if you just set up an after-tax account, you don't get a deduction and you have to pay tax on the earnings of the contribution. So you're really in no man's land. Okay, so Roth IRAs, there are no deductions for the contributions of $7,000 or $8,000. You can take those contributions out anytime you want, no tax because it's after tax. But to get the tax-free earnings from those contributions, to be able to take them out tax-free, you have to be 59 and a half, and the Roth has to be open at least 5 years. Okay, so I'm a big Roth guy. I wrote a book, In God We Trust and Roth We Prosper, a bunch of years ago. All my retirement accounts are in Roth. I contribute to the IRA Financial 401k in Roth. All my cryptos and real estate and stocks are always in Roth. Why? Because I will deal with my accountant who wants me to get the current tax deduction and do a pre-tax IRA. I will resist that because the goal is, I believe in the next 20, 30, or 40 years, the returns and the tax-free nature of those returns will clearly outpace any benefit of the deduction, right? If you put $7,000 and you're at a 30% tax bracket, to $2,100 tax deduction. Okay, that's good. I mean, who doesn't want a deduction? But my bet is that $7,000, whether I'm buying Tesla or Bitcoin or buying an ETF or real estate, I'll do better than I would just claiming a $2,100 tax deduction. So my accountant will say, well, that's true, but what happens if you lose, right? What happens if you invest in Silicon Valley Bank and it goes to zero? You just gave after-tax money, you didn't get a deduction, and you also didn't get a benefit. So that's obviously, the tug of war you have to play. I'm a pretty, diversified investor. I feel like I'm going to be able to beat that $2,100 per year on a deduction versus tax-free gain. So Roth conversions are really the golden nugget of retirement tax planning, because it's the only way you're going to be able to take pre-tax money and move it to Roth. And what's the advantage of moving pre-tax to Roth is, as I mentioned, once you're 59 and a half, the Roth's been open 5 years, everything in the Roth can be taken out tax-free. Whereas if you had a pre-tax IRA, once you're 59 and a half, you still have to pay ordinary income tax on your distributions. Okay. So yes, the money in both a pre-tax IRA and a Roth grow without tax. That's not known as deferral or compounded returns. So yes, they both share the same advantages. However, a Roth IRA can shelter all the tax on distributions so long as you're 59 and a half and the Roth's been open at least 5 years, as well as on contributions. Whereas if you have a pre-tax IRA, the money's still going to grow without tax in the IRA vehicle. But once you take a distribution and put the money in your pocket, you have to pay ordinary income tax on the distribution. So obviously, not that hard to figure out that you'd be in a better position, assuming your account grows, to have more of your money in a Roth than a pre-tax IRA, unless your tax rate is going to be zero. Okay, which, assuming our tax rate's between 15 and 37%, you obviously want to have a lot in a Roth. So before I jump into some of the Roth conversion strategies, which will then lead into oil and gas, let me just kind of talk about some of the basics here. Again, anyone could do a Roth conversion. Jeff Bezos, Adam Bergman, anyone could do it. There's no income limitations. IRS got rid of that in 2010. Why? They needed money. Roth conversions generate money to the treasury. Why? You pay ordinary income tax on the amount you convert. Okay, no penalties, but you pay ordinary income tax on the fair market value of the asset you convert, whether it's stock, real estate, cryptos, or whatever, or obviously cash, right? Cash is valued at what cash is, right? So if you have $100,000 in real estate or $100,000 in cash and you want to convert that to from pre-tax to Roth, that $100,000 would then go on your 1040, your tax return, and it would be aggregated with all your other income, and that would determine your tax rate and the amount of tax you owe. So conversions are great. Okay. Why? Because the more you can push into Roth, the more wealth you can generate tax-free, the better off you're going to be. Also, Roth IRAs do not have required minimum distributions, meaning once you're 73, you do not have to take any money of the Roth IRA if you don't want to. You can if you wish to, don't have to. Pre-tax IRAs have RMD requirements. When you die, your spouse could take the Roth IRA and then he or she would then have the ability to use those funds tax-free, or just leave it in the Roth and have the funds grow tax-free. And then when you and your spouse pass, then your heirs, your kids, non-spousal beneficiaries will have 10 years to pull that money out tax-free, right? So not only get to use the money while you're alive, over 59 and a half, your spouse can use it when you pass, and then you're leaving a tax-free gift, a legacy to your children or your other beneficiaries. So it's a really nice estate planning opportunity. Now, IRAs, Roth IRAs are all part of your estate, so you can't remove them from your estate. But right now, the unified credit is so high, it's over 11 million bucks. So with a couple, that's over 22 million bucks. So for most of us, having your IRAs in your estate is really not a big issue. Now, who should do conversions? Okay, this is a question I get all the time. So there's no right or wrong answer, right? Don't you hate when lawyers tell you that? They charge you, $25,000 for a memo and they don't give you an answer. Yeah, that's what they tell us and teach us in law school. But here's the answer. Obviously, the earlier you do it, the better. Okay, age matters, right? Doing a conversion at 80 versus 30, less room to grow. Can you afford to pay the tax, right? And that's what we're going to get to Steve's presentation. Can you afford to pay the tax on the conversion, right? You got to pay ordinary income, not capital gains. Do you have losses, NOLs, and maybe you have an oil and gas strategy that you can zero out or minimize the tax? What is your tax rate going to be when you're older? You plan on working your whole life? Or do you feel like, hey, I'm going to retire, play golf, sit on the beach, and my tax rate's going to be, 10 or 15%. So doing a conversion maybe doesn't make as much sense because I'm going to be at a super low tax rate anyways. So those are some of the qualifications, characteristics that you have to take into account, keep in mind when you consider doing a conversion. Of course, if you're a client of IRA Financial, it's the kind of stuff we can help you with, consult with. But ultimately, there's no right or wrong answer, right? If you converted Bitcoin in 2015, you're happy now. If you converted your Silicon Valley Bank stock, you're not happy, right? So there's no right or wrong. You got to kind of take into account all the risks, the rewards, who you are, your ability to pay the tax, which ultimately, comes down to be the most important question. Can you pay the tax on the conversion? Okay. And there's ways to minimize it. As I mentioned, the most common is using net operating losses from past years to eat up some of the tax. Maybe you can do conversions over a period of time, right? Let's say you have 100 grand in your pre-tax IRA. Don't have to convert all of it at once. You can do 10,000 over 10 years or 50,000 over 2 years. So let's say you're in the 15% tax bracket. Okay. You have another $30,000 of income before you go to the 20% tax bracket. I'm just giving you simple examples. You may say, okay, I'll do an extra 30,000 a conversion this year. I'm still going to stay in the 15% tax bracket and I'll pay tax. I can afford to pay the extra 15 on the 30. And I'm going to slowly get all my assets to Roth. That's kind of what I did over the last 15 years. I didn't just do Roth all at once because I didn't want to incur the tax. So I did it really over a 7-year period. And now I'm all in Roth, but it took me some time. Now, I wish I met Steve earlier because I probably just would have did an oil and gas investment and probably could have zeroed out all my taxes. But listen, this is the core of it. How do you move pre-tax assets to Roth? This is the billion-dollar question, right? Do you want to be a Peter Thiel and buy PayPal and Facebook and generate billions of dollars tax-free? You got to do it in the Roth. Now, the problem with the Roth, as I mentioned, is in the IRA case, you only can put in 7,000 or 8,000 if you're over 50. In the 401k setting, it's higher, right? You can potentially go up to 70,000 if you do a mega backdoor, or let's say you work at Tesla or Apple, you're going to be limited to about 23,500 or 31,000 if you're over 50 in 2025. So there are some limitations. So how do you accumulate a large Roth? Well, for most of us, it's conversions, right? Because a lot of us just start with pre-tax money through 401ks or defined benefit plans or 457, 403bs. And the Roth components really only came into being the last several years. Before that, most employer plans did not offer Roth components. Now most do, which is great. So there's going to be even greater opportunities to do Roth, and you won't even have to do conversions. But for everyone out there that still wants to go to Roth, which if you're able to do it, you want to be in Roth, right? Why wouldn't you? The only reason you don't want to be in Roth is if you feel like you're going to lose money. And if you feel like you're going to lose money, maybe you shouldn't do the investment. So of course, we're all optimistic. We all hope we're going to do really well with our investments. When you want to shelter them all from tax, I would. So that brings me to Steve. Steve, it's all yours.
All right, thanks, Adam. Lots of great information as always. You'll be recording this because I'm trying to write that stuff down as you're talking about all that good stuff. So oil and gas, what I'm going to focus on for my part of the presentation is, so oil and gas is a binary type of tool, right? It has a big tax strategy on the front side, but it is an investment. And it's very important to not lose sight of the fact that this is an actual investment. Our funds, our 506c offerings, they are specifically as a 506c for accredited investors. So if you're in that criteria, then this is something you can potentially use as a strategy to convert your IRA to a Roth, whether you do it all at once or you do what's called chunking, which is just pieces, a little bit each year. And so when you invest into oil and gas directly, meaning when you can go out and buy, the publicly traded E&P companies, a mutual fund, and ETF. But if you invest directly into the drilling of brand new wells, into what's called working interest. So working interest is essentially akin to equity in a well. And so every well that's drilled in the United States, especially onshore, there's working interest available for acquisition. And when you invest directly into that, the IRS has some specific tax benefits associated with them that has been in place for decades. So one thing to note about this is that the IDC deduction, which is the first one we'll talk about, has been around a long time. There's plenty of case law on it. It's not on the dirty dozen list of the IRS. So you don't have to worry about, audit risk from an IDC perspective. But the big write-off that would allow you to offset that taxable income that you would create from a Roth conversion is called the intangible drilling cost deduction, the IDC deduction. So essentially, IRS section 263C of the code says that you can take 100% of the intangible drilling costs of a well and deduct 100% of them in the year of investment. So what is an intangible drilling cost? Anything that we put into the ground, that goes into the ground to drill a well, that has zero salvage value when the well is over, is an intangible drilling cost. That's typically about 75 to 85% of the total cost of a well. So for example, our fund last year, right? If someone put in $100,000 last year, our K1s had an 83.6% IDC on them last year. So essentially your K1 on March 15th of 2024 for 2023 had an $83,000 loss. So that's the first step, right? But this is a passive investment. So obviously the next big question is, well, if it's a passive investment, this is a passive loss, how is that offsetting active income, which is basically what Roth conversion is classified as? So there's another benefit in the code. It's under IRS section 469C3, which is the passive active rules. That is a special exemption for investing directly into the drilling of brand new wells for working interest that allows you to take this loss of a passive investment and offset active income. So when you make the Roth conversion, right, that is now taxed at ordinary active income rates. So if you had an oil and gas investment outside of that, alongside of that, the loss in there could offset that. And I'll show an illustration to that in just a minute. So the IDC deduction combined with 469C3 exemption for passive active rules is how you get the big upfront deduction for investing directly into oil and gas. So, and again, just as a point out, it is for investing into brand new wells. You can invest into cash flowing assets, but those cash flowing assets don't qualify for the big write-off. So what are some strategies for that you can use this for? So obviously we're talking about the Roth conversions, right? So that's the one we're discussing here. But this can be used in multiple different ways. Adam was talking about managing your tax brackets in the example he gave. That's one way to use it for. If you have a one-time big chunk of income from a sale of a business, stock options, or you're just making a lot of money, kudos to you. But if you got a lot of W-2 income or a lot of ordinary income on an annual basis from your job, your business or your job, it's W-2. These are also strategies where you could take that loss from your investment into oil and gas and offset the tax bill by lowering your AGI. Let's go to the next slide. So this is a very basic example. So let's say you have $500,000 in a traditional IRA. You don't want to convert it all at once. Maybe you want to do $100,000 per year over the next 5 years. The term for that is called chunking. In other words, you could take 100,000, convert it. Let's assume that you're in the tax brackets at 35%, just for illustrative purposes. You're going to owe $35,000 on that conversion. If you make no investment, you just got to pay the 35 grand. If you convert that $100,000 on the right side and you make a $125,000 investment into oil and gas and assume an 80% IDC, you will create a $100,000 loss that will offset the taxable income from the Roth conversion, and now you'll own zero taxes. And so now you've saved that $35,000 in taxes, and $100,000 is now moved over into a Roth, which has all the long-term benefits that Adam discussed in detail at the beginning of this presentation. And just as a side note, there is a chat bar. If anybody has questions and want to type in questions, they feel free to do that. Right, Adam?
Yeah, Steve, can I just make one point?
Sure.
You can expand on. I think it's important to state that the oil and gas investment is made with personal, non-retirement money, right? Just to be clear, because oil and gas investments are not very tax efficient for a retirement account because you don't get all these deductions, right? Retirement accounts like IRAs, Roths, 401ks don't get deductions, right? They get to defer tax on gains and income, but they don't get the deduction. So just to be clear, this is with personal money, non-retirement money. You put 125K of personal money that generates the deduction, which then is used to shelter the tax on the conversion.
That's a great point. You need to have to be able to do this, you have to have the liquidity outside of your qualified accounts. And so at the very end of this, I'll have my information up, because remember what I said earlier, this is a great tax strategy, but this is also an investment. This particular presentation focuses just on the tax benefits and the tax strategy of oil and gas. But if you decide to even look into this, my suggestion would be is that you get on my calendar, we'll get some information to you, but there's a whole bunch of different things you need to be educated on how the investment works, what the expectations are for returns, what the risks are. But Adam's 100% right. You need to have non-qualified money to be able to do this strategy. If you invest through your IRA, you lose all the tax benefits. So that's not a suggested strategy.
Yeah. The only times I've seen IRA clients invest in oil and gas is through royalties, like not working interest and just trying to invest in the royalties, which is not this strategy. But I've personally invested in oil and gas over the last 10 years, like through master limited partnerships, but with personal money, non-retirement.
Yeah.
So, but yeah, I think this chart is really important. This is the crux of the strategy right here.
Yeah. And I think on the previous slide, there was, if you go to the back one slide, Adam, or one more. So just the last couple tax benefits associated with oil and gas. There's what's also called the small producers tax exemption, which is section 613 of the code. As you receive the cash flow, it's a tax efficient stream of income. It's called a depletion allowance. You only pay tax on 85% of that cash that you receive. So investments in direct oil and gas are a great tax strategy. They also create a passive income stream. It is a physical asset. It is a recorded deed of title at the county for that working interest. There is no leverage involved, and it's not correlated to the equity or bond market. So it does flatten out the volatility of a portfolio. So it's an alternative asset that is not liquid, which is another important part that you need to understand. But again, if there's any interest in this, you need to spend a whole nother amount of time learning about the actual investment side of it. This is focused on the tax.
Yeah, hey, Steve, how long is the investment life cycle of an oil and gas investment?
Yeah, it's at least 5 years. So it's a minimum of 5 years, maximum of 10, particularly for our fund. Now, there's other investments out there that these wells will produce, most wells in the United States will produce for 25 to 30 years. So there are funds out there that will have the funds stay open that entire time, but we'll keep ours open a maximum of 10. But somewhere between years 6 and 7, we typically we'll sell the cash flow and make a final distribution. So that's another aspect of it, but it's illiquid. So it's important to know that, one, as Adam mentioned, you're investing non-qualified money, meaning non-IRA money. So you have to have the liquidity to do it. And then it's going into an alternative asset that is illiquid, right? So in other words, I tell people this all the time, this is not an investment where you can put in $100,000 and call up in 6 months and say, I need to liquidate my position. Once you're in, you're in. So that's the difference between investing into an ETF or a stock or a bond, right? You typically can get your money out without any penalties. And that's my information. So if you can go to our website, there's current deals at the top, which would get you to the data room. That's my email address, my mobile number. If you have any interest in learning more, send me an email or call me, and we'll get some information to you. And then you can still do this for 2024, by the way. So any of those strategies work. The fund is open till the 31st. You make an investment for the end of the year, it will qualify for a 2024 write-off, but there's not a lot of time left. And my suggestion is that we would schedule a Zoom call so I can walk you through how this investment works. What are the expectations, but also what are the risks? Because there's risks in every investment. There's no such thing as a risk-free investment.
Yeah, and again, just to be clear, we're not promoting investments. This is strictly for education, information purposes. So it's important just to know whether you want to invest with Invito or any other oil and gas investment partnership, that there are opportunities to shelter the tax on a conversion. But like Steve said, there's long-term lockups of probably at least 5 years, and like any investment, there's obviously risks that the investment doesn't work out. One other thing I want to mention too is that accredited investor. So you mentioned accredited investor. Generally, that's someone who has $300,000 if you're married, filed jointly of income, or $1 million of net worth excluding a primary residence. So generally, right, in a lot of these deals, Steve, you got to be an accredited investor.
Yeah. Yes, you do. It's a 506C offering, which requires you to be accredited and to verify accreditation. So that is absolutely. I just saw the Q&A button down the bottom, so I see a few questions in there. I can
Oh,
answer some of those. Let's see. Jay said, you mentioned you acquire working interest, working, not overriding role. Holders of such interest, as you know, are typically liable for any further capital calls. Okay, so our funds, if you got our PPMs, you would see that we don't have capital calls in our fund. So different deals are set up differently. There are plenty of oil and gas deals out there where you are subject to capital calls. That's not the case in our private placement memorandum. How do you invest in oil and gas? You invest in oil and gas. Well, we invest in oil and gas by acquiring working interest in what's called non-op working interest in other company wells. We focus on 5 major oil basins in the United States. We are acquiring working interest in wells that are being drilled by some of the largest E&P companies in America. So again, I'm not going to take this week. That's an hour conversation, but if you're interested, get on my calendar or send me an email and we can talk in detail how that works. Does the investment make any money? Is it a good investment? Jenny asked that question. Well, Adam's not going to answer that question because he's providing education. My answer to that is it better, because that's our job. So that's what we're in the business for. So if the funds don't make any money, then I'm not making any money. But again, a lot more detail to go into that if you have any interest. Let's see. See in your example, you have 125 clays plus. In your example, you have yes, you have to put in 125K. So if you convert 100 grand, right, that's going to create $100,000 of taxable income. If you put $125,000 into a drilling fund and it has an 80% IDC, 125 times 80% is 100,000. That $100,000 loss would eliminate the 100 grand income from the Roth conversion.
yeah. So just on that, Neil. So when a conversion is basically just an exercise of moving paper, really, there's nothing else to it. It's really just moving the account from an IRA to a Roth. You don't have to sell the house, or a lot of guys even move the cash, right? It's just literally an accounting. And then we'll issue a 1099-R to the IRS. And then obviously a copy to you so you can report on your tax return. You'll provide us, if it's an in-kind asset like real estate or private stock, you'll give us a valuation. We don't require you to go get, KPMG or Deloitte to do the evaluation, just someone independent. Obviously, if it's cash or publicly traded an asset like Bitcoin, that's not really a problem. So anything illiquid, we're going to need some type of independent valuation. We'll 1099 it. But Neil, no, you don't need to put an extra 100K in. The 100K is just an accounting of the movement from the pre-tax to Roth. But there is a need for 125,000 investment of personal non-retirement funds into an oil and gas deal, which would generate 100K of losses. Deductions, sorry.
Yeah.
Yeah,
said, what amount of dollars do you need to invest to get a $35,000 deduction? So our minimum investment for our fund, there are other oil and gas funds out there, is 50 grand. So if you put in 50 grand and you had an 80% IDC, that would be a $40,000 deduction. If I invest my personal money, 125 grand, and lose 80, not sure I understand the question, but yes, you're going to get the big write-off up front. But the strategy, again, it's a binary strategy, right? It's a good tax strategy, but it needs to be a good investment. So the plan obviously is to not only get your return of capital back, but to make money on top of that. That was for Grace.
Here's this one from Anonymous. No, I don't think it makes sense unless you really want to do an oil and gas deal to strip your IRA money out to do the oil and gas and pay tax on distributions. Unless you're dying to do an oil and gas deal and you think it's going to hit a home run, then it's your call. But generally the strategy is you want to convert and you have some extra non-qualified cash out there and you're going to generate the deductions and hopefully generate returns, right? Like this isn't just about getting deductions. It's also about getting returns in the future.
Yeah. Neil says, what happens if the oil well is dry and all the investment goes to zero? Well, if you invest in the wells that produce nothing, then you're not going to make any money. So once again, what I would tell you is if you have any interest, serious interest in doing something before the end of the year, we would get on a call and explain to you how we choose assets, how we underwrite, how we manage risk, and how we basically eliminate we don't invest in the wells that are going to drill dry holes. So, but there's plenty of that out there, but we don't do that.
It could happen though.
It could happen, but there are ways to invest in types of wells to invest into, which pretty much eliminates that you're going to drill a well and it produces zero. You can drill a well and it doesn't produce what you think it's going to produce, but drilling and producing nothing is a certain type of exploration that we just don't engage in. And again, would go into much more detail of how that works on a one-on-one.
Yeah.
What is the risk of the investment? Same type of any other risk. The risk is it doesn't perform to expectations. Holding periods at least 5 years.
Here's this. So to be clear, I would need more than double the amount of my Roth conversion in order to reduce or eliminate the impact of the conversion.
In the example we gave, right, you have $100,000 conversion, you make $125,000 investment. So I don't know that necessarily double, but to wipe it out. Now you got to remember, this is if you want to eliminate, you could do this and also reduce the tax liability, right? Right, Adam? You don't have to, the strategy doesn't have to be all or nothing. I mean,
No.
you could just decide, maybe you have some NOLs or some losses on your tax returns or some other strategies to create some losses. And then you can use oil and gas to reduce the rest of it. So again,
Correct.
you can go the strategy of trying to get rid of it all, or you can go the strategy of reducing that liability from the conversion.
Exactly. Exactly.
Minimum to invest with us is 50 grand. That's different with other funds, but that's what ours is. It's only offered to accredited investors because our fund is registered under the SEC as a 506C offering. So if we were a 506B offering, then you could take non-accredited investors, and there are oil and gas funds out there that do that. We specifically don't do that.
Here's one. If you have a Roth IRA and it hasn't been open for 5 years, do you pay tax on the earnings? Yeah. In order to get a qualified Roth distribution, it has to be 5 years and 59.5. Now, this individual, one benefit is the contributions you made can be taken out tax-free, but the earnings, you need the 59.5 in the 5 years to receive a qualified Roth distribution.
What year do the wells typically begin to cash flow? You'll start to receive your cash flow in year 1. How past funds performed again, Chris, if you're interested to get into details, hopefully you got my information, shoot me an email and we can get some information in front of you.
The oil and gas 1031, that's not really relevant here because the whole idea of this oil and gas investment is to generate the deduction. Also, hopefully to receive value on the investment, but at least initially in the first year is to generate a large deduction to offset the conversion. So I'm not sure a 1031 is going to matter.
Yeah, but I'd have to think that one through, but I would the answer to the last part of your question is they are independent transactions and yes, they do need to occur in the same year. So your Roth conversion and your oil and gas investment need to match calendar tax years. So you can't convert in 24 and then invest in 25. That's not going to do you any good.
Yeah.
Benjamin, I would, if you want to get into the details that granular of a level, let's get on a call. Trump says.
What about Trump? Yeah.
What I would say to everybody, obviously with the recent election, I get asked this question a lot. What I would tell you is that no president has the ability to force drilling companies to drill or not drill. The only true power the executive branch has is to ban fracking or leasing on federal lands, which the Biden administration did do at the beginning, and they did make it difficult for offshore. But there are plenty of state lands and private lands to drill in this country. So I'm a little agnostic to who's in the office in terms of liberals or Democrats or Republicans, other than they certainly, with the new administration, the regulatory environment will definitely get a lot more favorable, which will just reduce the costs to drill wells, which will be beneficial to investors.
Okay. Here's a Roth conversion already occurred. That's okay. As long as you make the oil and gas investment in 24, you're good. You can use
Yeah.
the deduction.
So yeah, to anonymous there, you have to invest before the end of the year. Our fund is open till the end of the year, but you literally have to put the money at risk before the end of the calendar year to qualify for 2024. And again, if you want to get into what the expectations are of our investment, reach out to me.
There's a K1 that the investors will receive that shows the gains, the losses that could be used to offset on your tax return.
Oh, Richard's question. You see Richard's questions, Adam?
Oh, here it is. Yeah.
My understanding is earned income. So it's definitely taxed as, well, it's a passive income stream paying ordinary rates, which goes on a Schedule E and an SE. I don't believe that's, so you're going to receive a K1, which will flow through to your Schedule E to your 1040. I don't think you'd have a Schedule C you wouldn't have a Schedule C with regards to oil and gas income.
No, it'd be a K1.
Yeah, and I don't.
You get a K1, which you could use it to offset against ordinary income.
But you couldn't set up, I mean, solo 401ks, and you know more than I do, but solo 401ks have a whole bunch of other rules associated with it. But I would say that I'm not the expert at it, but I don't think you can set up a solo 401k based upon making a passive investment.
No. The solo K, no, the solo K is set up by a business. A working interest income is not self-employment income. It's passive. So no, the solo 401k would not be adopted by a working interest type passive investment. It'd be set up by a company. Now, could you potentially do a conversion in your 401k and then use an oil and gas investment to offset the conversion? Yeah, you can do that. But the 401k is set up by a business. It's used to then create an investment vehicle and also a vehicle for making contributions. But then what you would do, Richard, is you would then make a personal investment into an oil and gas if you wanted to do a conversion in the plan to offset the tax on the conversion. But
And Neil, yes, you could take the passive income and shelter, offset passive losses. But I would always say run that by your CPA. Adam, you're going to send these guys a recording. That's been asked a few times.
Yeah.
How does this compare to investing in MLP? Just a totally different structure. It's not a tax credit, it's a tax deduction, Neil. So not a tax
MLPs
credit.
are similar. The difference in MLP, they're still investing in a lot of cases in oil and gas, right? It's just a different structure.
Yeah.
Is it tax? Okay, it's not a tax. It's a deduction, not a credit. Credits are great. Deductions are not as great as credits, but they're much harder to get credits than deductions. What's a typical return? Just like, what could someone expect? I'm not saying anything to do with you, but in the industry over the last 20 years, like what should someone expect over the life of this investment?
Yeah, I mean, I'm not going to talk about the industry, but I'll talk about what we do. Where we underwrite to is about a 15 to 20% annualized return over the life of the asset. And so obviously there's a lot of things that affect that, specifically commodity prices. But again, we would talk to you about how we manage commodity price risk. And Neil, yes, you can get the tax credit this year to offset. If you don't do that slide that I showed you, right? There's a whole bunch of, if you make a bunch of money on a W-2 or you're self-employed and you make a bunch of money, you have a one-time event, you can use the loss on the K1 from this investment to do offset any type of ordinary active income, not just Roth conversions.
Okay, I got the 5-year rule to hold a Roth IRA. That clock starts when the Roth IRA is open and there's $1 in it. Okay, so there's no restarting. Once you do a Roth IRA contribution into a Roth IRA, even if it's $1 when you were 18 years old, at 23, you solve the 5-year. Even if you open up another 50 Roth IRAs at 50 different banks. So that's why I always tell people at 18, put $1 in your Roth IRA, just knock out that 5 years and you're good. Is there any strategy that utilizes Roth conversions and reducing future RMDs? Yeah, anonymous. If you have a Roth, there's no RMDs. So getting your
Yeah.
money into a Roth will eliminate RMDs. Now, if you have a pre-tax IRA, $1.5 million, you have to figure out if it makes sense to convert, right? If you do an oil and gas strategy, maybe Steve or could reduce your tax, or maybe you got a lot of losses from other sources that you can use to offset the income. But, or maybe you want to convert over the next 5 or 10 years. At that age, conversions are generally not as popular versus doing it in your 20s or 30s, but I've seen clients do it. One in particular had a private investment that he felt was going to go public. This was like during COVID, and it actually did. The guy made like 25 million bucks, and he converted it at a very low value, and it worked out. He was in his 70s. So for him, he had an investment he felt really confident about, and he was willing to wait that 5 years, and the value was super low. It was under 50K. At a 1.5 million, that's a big conversion number, right? Assuming almost 40% tax, that's a big number. If not in a high tax rate, no need to use a strategy to reduce the income base. Well, I mean, it depends, right? Even if you're at 15%, you can decide if that's worth it or not. But remember, as you convert, that is going to be added to your ordinary income, to your W-2, and it's going to increase potentially your tax base, which could increase your tax rate, right? Let's say you made 80,000 bucks as a W-2 and you're converting 800. Guess what? You're now in the 37% tax rate. So that's something we can help you with and kind of play around with your income, see what tax rates you are. But yeah, this is why it's not always for everyone, right? Sometimes I've told people, hey, don't do a conversion. It doesn't seem like it makes sense for you. You're going to be in a low income tax bracket in the next 10 years. Just pay 10, 15% when you retire. Who cares? Versus others saying, hey, Adam, I'm definitely going to work my whole life. I plan on making, 6 figures, and I'll probably be in the 25% plus tax bracket my whole life. So conversions is something I'm going to consider. Okay, we did this. We did investment holding period. Can I invest 125K of my solo? Remember, Chris, this is for personal investment, non-retirement account. You don't want to invest your solo K in oil and gas. There's no tax benefits. You can invest your solo K in stocks or real estate, Bitcoin, something else. God bless you. But you don't want to do an oil and gas. You can do a royalty deal. Do not do a working interest. This is, again, just to be super crystal clear, use non-retirement money to do this strategy, buy oil and gas investment, generates 80% of the investment and deductions in the first year, and you offset it from a conversion that you did in IRA or plan.
Yeah. And Mark, the answer to your question is the return of invested capital happens before the investment period's over. So, and then yes, to anonymous attendee, that is the production line behind me. That is Gordy Howe, Ted Lindsay, and Sid Abel. And no, they're not investors in our fund, but yes, that is who's behind.
Where's Steve Eiserman? Steve Eiserman's not there either.
Not on that one. That's the famous production line. All Hall of Famers.
Yeah, great. Okay. On the amount that you convert to Roth, how much is untouchable for 5 years? So anything you contribute, you can touch. So if you put $1,000 in and you invested in Bitcoin and now it's worth 2,000, you can always pull out the 1,000 contributions. The thousands of earnings, you need to wait 59.5 and 5 years to pull out. Otherwise, tax and 10% penalty. Any recapture deductions?
There can be, but that's why you don't sell before 5 years. If you sell within the first 2 years, you'd have a lot of IDC recapture, which would be defeat the purpose of doing it.
How long have these tax provisions been in place?
I believe I think these were put back in place in the early 70s to incentivize capital to flow to the development of hydrocarbons in the United States because we were so foreign dependent on oil for such a long time. They get bantered around, as you know, every 4 years, Adam, as a political pawn, but they don't ever change them. We're certainly not going to change them with the new administration.
Yeah. Yeah, if you're 59.5, and again, you don't have that 5 years, you're not a qualified distribution, you pay tax. So that's why you got to have both. Any, I don't know, 506Bs that you recommend?
Yeah, no.
No.
I'm not going to recommend other oil and gas deals. But I'm sure you can go online and you can Google oil and gas investments, and I'm sure all kinds of stuff will pop up.
Okay, I think we're going to stop now. We got a lot more slides.
Yeah, there's a lot of questions.
Yeah.
K1s are sent out on March 15th, Chris.
Yeah, I think we're,
Can you pop up my last, I don't, someone's asking for my information one more time.
yeah, let me find it. Yeah.
Is on that, send me an email is the easiest way to get a hold of me, or you feel free to, that's my mobile number. Feel free to call me, text me.
Yeah, and just be clear, IRA Financial, we are not allowed to endorse any investments. We're not endorsing any investments. This is purely educational.
Yeah.
So if you talk to Steve, it's.
And I am an IRA financial client, by the way.
You are, and we appreciate everything you do, but we're not allowed to endorse investments. We're not obviously a broker dealer. We're not regulated by the SEC. We're simply a self-directed IRA company that helps people unlock their retirement money. And we like being neutral and totally agnostic and loyal to our customers. We want our customers and our clients to do amazing. And we don't like promoting investments because, God forbid, something doesn't work out. We don't want to have that relationship strained. So it's better this way. So I think we're going to end it here, guys. A lot more questions. We'll do a few more of these, but that's it for now.
Yeah.
I think crypto, I'll do another, I'm going to do a YouTube live on crypto at some point because it looks like Bitcoin's going to hit 100,000 before we know it. Maybe even it's hit it already. So
maybe even today, right?
Yeah, maybe even today. So it's very exciting. I've been investing in Bitcoin since 2015. I wrote the first book, How to Use Retirement Money to Buy Cryptos, back in 2018. So this has been a good couple months, definitely.
Yeah.
Really exciting. So that's it. I think I want to just thank everyone for participating. Thank you, Steve. Thanks for the hundreds of people that have signed up. If you missed this, don't worry. We're going to provide the broadcast so you can review it and watch it at your leisure. And again, if you have questions for Steve or for me, reach us. We're looking forward to hearing from all of you and trying to educate everyone on Roth conversions and the ability to use a retirement account to maximize wealth and also minimize taxation. So I think that's it for today. Thanks you so much for participating. Thanks for all your time, your dedication, support, and have a great holiday.
Thank you, Adam. Take care, everybody.